Hey guys, Mike here. So everyone talking about SoFi stock news, and there's quite a bit out there. And so, I'm going to talk about what are the 3 reasons the stock's being hammered down and just beat down like it stole something. There's 3 really main reasons that you need to understand, because you're probably sitting there going, I don't get it. What's going on? Because earnings was good. They didn't miss it. They didn't miss the numbers, right? They didn't downgrade the forecast like other companies did, right? And so, there's something called guilt by association. I'm going to show you that. But I'm going to show you a prime example. When I say what kind of market we're in, I'm going to show you exactly what kind of market we're in and how, SoFi is basically just being punished for other people's misdeeds, right? We're going to hear from the CEO. And then I'm going to talk to you about something, we got to keep an eye on this. I knew it was high, but honestly, I've never seen it compared to other companies. But this is a major issue that is also affecting this company right now, and I'll tell you why as well. And it's big. I mean, I didn't realize the numbers were this skewed, and if it's true, the CEO needs to address it. And I got an email sent to Investor Relations, just FYI. We'll see if I get an answer. I see people on his Twitter to the CEO, Anthony Noto, who I have a lot of respect for. I think he's a fantastic CEO, saying, hey, can you kind of address this? And it's just something for us to keep an eye on. And I'll tell you why you'll see why this kind of stuff comes out now. I'll explain that as well. I think it's important to understand that. And, so if you're getting out of it, really appreciate it if you just hit that like and subscribe button for me. Notifications all, guys. I really appreciate all you guys that do that for me. It helps get the video out and stuff like that. And so let's first hear from the CEO, because I've talked about this before. And you're going to hear him basically kind of back at what I say. So it's not just coming from me. It's coming from the CEO, and I think the numbers prove him out.
So the strategy behind the stadium was to build credibility through the association with the Los Angeles Rams and Chargers and the National Football League, and drive really efficient mass reach. So throughout the season in the fourth quarter, we had 5 nationally televised primetime games, and each game averaged about 22 million household viewers, over 100 million in total. That helps increase our brand awareness. It helps make us a household name. It helps drive trust with us. So when our products are marketed to you, you'll have a higher probability of being responsive to them. So I wouldn't say it's immediate. It's a continuity strategy. It really paid huge dividends in the fourth quarter. We had record member adds. We exceeded our full year estimate for 3 million members, finishing at 3.5 million members. And we had very high cross-buying rates. 30% of our products bought in the quarter, which was also a record at 900,000 new products, were from our existing members. So the stadium is a critical component of the broader strategy, and it's really paid dividends as we saw in the fourth quarter.
And it's good to hear that. I mean, is there really any scientific proof behind it? Not really. But, the fact they're hitting their numbers kind of proves it. And the fact, remember, he was the CFO for the NFL. Okay, so they had a leg up in getting that contract. And which stadium they chose to go into that stadium was genius to have 2. I mean, I'm a big football guy, so I kind of know a lot of stuff about football, but to have 2 at this time winning teams in that stadium, to have the Super Bowl in that stadium this year, to have all these eyes on your product, it's great. I mean, that's what really sells stuff. There's a reason why Doritos pays so much money to put like 3 or 4 Doritos commercials in the Super Bowl. It's millions and millions of dollars. You know how many bag of chips they got to sell just to recoup what they pay for the commercials? But I guess it works because they do it every year. That's just a guess. I'm not in marketing, but it seems to work. And so, I'm good with that. They give classes there. They do all kinds of stuff there to help sell the brand, right? And so that's good to hear. I kind of figured out what was going on, but at least I want you to hear it from the man himself. And so let's get into the chart, and you'll see what's happening. And then I'm going to show you exactly. It just paints a picture of, what is going on in this market right now. And so, of course, this never gets old. You see this on every growth stock and in all the indices right now, this downward descending trend line, right? We're still in this. As you can see just major selling off since earnings. It continues. It's gone below $10, obviously. And the reason why, this is bad is because that last support line, remember, they're a SPAC, right? $10 is what they start at. Okay, they are below that. All right, and so what does that mean? That means 0 support lines from here. That means algorithms jumping on this stock like they have all the other SPACs. I could pull up, and I thought about doing this, but I decided not to, because you would click off the video. 100 other SPACs easily, very popular SPACs, that once they went below $10, have been just absolutely beat down, shorted, however you want to put it. Hammer down, because when they see there's no support lines, what do you think starts happening when they get below that? people start going, I'm out of here, because they've seen this movie before. Is that going to happen to SoFi? I hope not. That is my hope. But if this market continues to sell off, as you can see, once it went below 10, right, a lot of selling, okay, because there are, you know, SPACs out there that make money, their revenue, all this stuff, they're down to $2 right now, $3, $4, $5. That should not happen to SoFi. I mean, this is a company that generates a lot of revenue, but remember, what times are we in right now, right? They have a lot of debt. They're not profitable, not even close to profitable right now, right? And so these are not the stocks that get rewarded, plus everybody hates SPACs. And so that is a big thing. And so that's the number one, that's one of the 3 reasons I'm going to tell you they're selling off hard right now. So to get above that last support line will be huge for this stock, okay? I'm just telling you like it is. I don't sell stocks on here, just try to put the facts out to you, but you can see it plain as day on that chart, okay, what's happening. Number 2, what kind of market are we in right here? Let me show you a prime example. Remember, SoFi did not miss any numbers on the earnings, gave great forward guidance, didn't downgrade their forward guidance or anything like that, right? And then what happens? They sell off. Look at this company right here. Let me show you what kind of market we're in. Peabody Energy here comes out. They get a $534 million margin call on coal. And then on top of that, Goldman takes advantage of it. Congratulations to them. Rakes them over the coal with a line of credit at a 10% interest rate, right? I think it's $1.5 million or $150 million, I think it is. And, you know, what happened was they locked in the price to sell coal at $84 a metric ton, you know, a couple years ago where it was, because coal wasn't very popular. Well, times have changed, right? Commodities are going through the roof, and, you know, it could be a shortage of coal. So coal is skyrocketing, right? And so those hedges obviously didn't play out very well for them. And here they are in this situation, right? So imagine, you would think this stock would just be in free fall after that, right? So what happens is the news comes out. Obviously, it's done a massive run-up, as you can see right there. Massive run-up, because all energy stocks are. There's a nice sell-off right there when the news breaks, but hits the brakes, right? Very quickly. Turns around, says, nope, coming back up, pops right back up right there, does a little sell-off, and now it is on its way back up, as you can see. But imagine the same thing happening to a high-growth stock of anything like that. What would be happening to that stock? You've seen it in earnings calls. Look what happened to Netflix. Look what happens to, what was it, Snow? Got destroyed, right? There is no, when you're in a downward trend, unlike that one, see, they're in an upward trend. The momentum is with them, right? So they can make mistakes. Forgiveness is there because the momentum is with them. When you make mistakes coming down and you're already in a downward trend, there is no mercy. People jump on you, they dig a shovel, throw you in the grave, and bury you. That's what happens. And that is what is happening to all high growth stocks, no matter what. And SoFi hadn't even made a mistake yet, right? Doesn't matter, okay? When other high growth stocks in their industries, you see, make mistakes, they get to pay the price too. Guilt by association, all right? So number 2, momentum's heading down. It just isn't in their favor. Right now it's all about commodities, right? Energy, oil, gold, you name it, silver, whatever. That's what everybody's playing. Fertilizer, okay? Those kind of stocks. Cyclicals, boom, right? That's where everybody's heading. So if mistakes are made in the fintech industry, SoFi pays with it because momentum is heading down. As you can see right here, with the fintech stocks, you know, just going back over, you can see right here, look, SoFi is actually not as bad off as some of them, right? I mean, you got Upstart down 70%, you know, Lending Club 68%, but you just look over the last 5 days, you know, all of them in the negative, right? Upstart's down 20, you lost 25% of its value in the last 5 days, right? SoFi's down 9, SoFi's down 15, Lending Club's down 10, Square and PayPal between 2 and 5 in the last 5 days. And, you know, I'm not the only one that thinks this. This is where, you know, I like Josh Brown, I like listening to him because he's really blunt, honestly. And sometimes he says some good stuff, and he kind of, you know, gets into high growth stocks as well. He doesn't snub his nose at them. And, you know, listen to what he has to say about it.
This is a huge asset to the company. I have not pulled the trigger yet, whoever asked you the question, but this is very much on my radar as a disruptive company that just got lumped in with a lot of other fintech stocks that have been killed. I really don't understand why it's as low as it is. I'm going to do a little bit more work, but I may end up owning this.
And of course, you know, this leads us into what happened. They end up, Piper Sandler comes out and says, nope, price target's $12 a hold. This was 6 days ago. Still a 40% upside from where it's at right now, obviously. That's after you got all these buys that went on, you know, basically 10 to 12 days ago from Morgan Stanley and them. You know, and then of course, you see, and understand, you're going to see this about the CEO buying. He hadn't had an informative buy in a long time. But if you look, the reason why he's buying, look at the amount, 149,000, 149,000, 149,000, 149,000. It's the same amount every time. And it's like, basically every 3 days until that last one. But what he's trying to do is stabilize the stock. He realizes what's happening. He can see what's happening. He's a very smart guy, right? I mean, he's a Goldman Sachs guy. He sees what's happening, and so he's buying, okay? And he's getting it for a cheap deal, so why not? Because, I mean, that kind of money to him is nothing, okay? And so to me, those purchases, I mean, if you want to believe there because he's confident in stock, that's great. It's good to see the CEO buy, but because they were the same amount of money, almost identical every single time as it was going down, he's not dumb. He knows what's happening. Again, he worked at Goldman Sachs, CFO for the NFL. The guy's smart, okay, when it comes to finances. He sees all the momentum and selling pressure on his stock. So what do you do as the leader and the captain of the ship? I'm buying, right? So, I mean, he spends $600,000. Again, he pulls out his wallet because that's how much money he makes up there. So here you go. Let's see if this helps, right? Of course, it did not. It still continues to sell off. We'll see if he continues to buy. And so I appreciate him buying, but it's been a long time since he had an informed buy like that. Most of them have been all the stock options we're going to get into. But the third reason it's selling off is really just a combination. It's just news coming out now, right? This is what happens. The stock starts to sell off, a lot of selling pressure, breaks down below that last support level, and now we're going to start bringing out some news and trying to pile on here, see how low we can get this stock to go. And of course, Anthony Noto comes out, because one thing it is a risk for them is if the student loan moratorium gets extended again, that would it'd be pretty bad. I mean, you're talking about, millions of dollars potentially. And so that's not a good thing. So, hopefully people start paying it back in May, because there's really no reason not to at this point in time. But again, we'll see what happens on that. You never know. And the other big thing this leads me into, and this is one that I say you can't make mistakes, right, when you're on a downward slope like they are right now, and it is the stock-based compensation. And these numbers are pretty staggering if you've never seen them. And I knew their stock-based compensation was high, like a lot of other companies, but when you see them compared to other companies, like it's not even close. If these numbers are true, hopefully we get some response from the CEO, like Palantir's CEO finally did. Took him a while to come around, but even he saw this as a problem. But you see right here, their stock-based compensation is growing. The percentage of stock-based compensation compared to revenues is growing faster than the revenues are, right? I mean, it's pretty crazy when you look at that. But when you look over here, look at this one. When you compare it to Upstart, Lending Club, and all the rest of these guys, that's the revenue growth, right? They're 74%. The others are 263, 157, PayPal's 18, all that kind of stuff. But then when you go over to stock compensation as a percentage of revenue, SoFi is 3 times that of Upstart, 3 times that of Lending Club, PayPal. What are they, like 5 times almost? That right there. And you go down the list. I mean, some of them they're 20 times, right? Those companies. And so you just kind of look at that, and it made me think of Palantir. And the bad thing is, it's not going to stop. It's actually going to increase even more coming up here. You see 2021 actual. You see it's increased every year. Look at 2022 guidance, right? And so I think it's like a 44% increase or something coming into next year. And I say it makes me think of Palantir. It's because of the earnings call, which if you're into Palantir, you watch that video, you'll see where I showed you. Finally, the CEO came around and said, "Man, we got to be profitable on a GAAP basis. We cannot do that if we continue to increase our stock-based compensation, and we're not in line with other competitors, right?" And so that's what they're working on doing over there. It took him a while to come around to that. He was very stubborn for a long time on that. I just want to hear what Anthony Noto has to say, because looking at that, if those numbers are true compared to the other companies, that's pretty out of line with other fintechs, okay? And I'm not saying I'm not going to go through every person's financial statements to confirm that, but I mean, I would assume they did some research on this, or he would already come out, because a lot of people are asking about that. I'm sure other investors have sent emails, so maybe they'll come out and talk about it. But I do want to say this: people think, oh man, if it's stock-based compensation is it's a bad thing. The stock can't go up with all that kind of stock-based compensation. And it's kind of like this. This is what I'm talking about with momentum. When, for example, Palantir or SoFi was going up, right? SoFi, prime example, went up multiple times. The shareholders were still being hurt by all that stock-based compensation, but the stock was still going up, right? Nobody cared. Nobody talked about it. But now, again, you're on the downward slope, so it looks worse, right? And if those numbers are true, they definitely need to come out and start talking like, wait a minute, what's going on here, right? I know it saves cash, but good Lord, you got to be somewhat in line and competitive with your competitors here, right? And be fair to your shareholders, because if not, it looks like wow, the executives are making out like a bandit up there, right? And so, but they're hurting us. And so, because they're creating more and more shares, right? And so it just looks worse on the way down. If and when, I mean, we know the market turns, it always turns. But when it does, and we start going back up, nobody will talk about it. They act like, companies that have stock-based compensation, they can't go up. That's just not true. You look at Palantir's chart, it went up multiple times, right? And guess what? We were still being liquidated as shareholders. They were still getting that stock-based compensation like crazy, right? Even more than they were now. And the stock went up, like quite a bit, right? Both these stocks are going up. But, it's just one of those things. I'm going to put it out in the forefront. You need to see it. Obviously, send some emails in. Maybe you'll get a response. I haven't got one yet, but we'll see. If I get a response, I'll let you know. Or if I see somebody else's response, I'll let you know as well. Because I think it is something that needs to be addressed. It's the way it is fair. We're shareholders. We got the right to ask questions, right? And so, there's maybe looking out for our best interests. And so I want to know. And so, hopefully you got something out of that. That's kind of the 3 reasons why you're seeing this right now. I don't know where the end is, because if the market starts to turn green, odds are you'll see Sofi turn green and some other growth stocks. If the market continues to sell off, which some people are predicting, then most likely you'll see these fintechs are going to sell off too, like other high growth stocks, okay? Because they are not gold, they are not defense contractors, they are not any kind of commodities or anything like that. That's what's hot right now. They're not cyclicals. And so, that's what we're going to see. Remember, we got the FOMC meeting coming up this week where they're going to probably raise interest rates. That's what everybody's expecting at least. And so we'll see how this affects the market. I got a video coming out about that too. And so if you got anything out of it, hit that like and subscribe button, notifications all. Really appreciate that, guys. And I'll see you tomorrow.